Alright, so let's get right into it. When we talk about the crypto market, you often hear the term Bitcoin whale. Now, what exactly is that? Imagine the entire ocean is the Bitcoin market. Most of us are like small fish, maybe some medium-sized fish. We can buy a little, we can sell a little, but our actions don't really make any big waves. A Bitcoin whale is the massive blue whale of this ocean. These are individuals or institutions. They hold an enormous amount of Bitcoin. We're talking thousands or even tens of thousands of coins. When they decide to move, they don't just make a splash. They can create a tsunami across the market. Whales aren't just one type. Early adopters, mining on laptops back in 2010. Large financial institutions, hedge funds. The key thing is their power. Their decision to buy or sell can dictate the market for days or weeks. So here's what went down, and it happened fast. Just a few days ago, the market looked pretty stable, hovering around $70,000. There was a lot of optimism, people were getting comfortable. Then out of nowhere it happened. A single, colossal entity, a whale, an early Bitcoin miner. They decided to cash in massive profits. This wasn't a small sale. It moved billions of dollars worth of Bitcoin onto exchanges. The moment those coins hit the open market, the floodgates opened. Prices began to crumble in a terrifying freefall, wiping out weeks of gains in hours. The immediate effect? A gut-wrenching drop of over $4,000. Bitcoin plunged from above 70,000 down to the mid-66,000s before anyone could react. It wasn't gradual, it was a sheer cliff. The sell order absorbed all the buy orders in its path and then some. Traders watching their screens faced pure chaos. Charts turned into a sea of red candles. Each candle meant more money lost. One player's action overrode the sentiment of millions of smaller investors, triggers automated sell orders, and causes panic among smaller investors rushing to sell. That created a vicious cycle of selling and liquidations. The market is still reeling from the aftershocks. The moment Bitcoin started its nosedive, the panic wasn't contained to just one asset. It immediately spread like wildfire across the entire crypto ecosystem. Think of Bitcoin as the sun in the crypto solar system. When it wobbles, all the planets feel the gravitational pull. Altcoins often follow its price movements, but with even greater volatility. So, when Bitcoin dropped by about 6%, many other popular coins saw drops of 10%, 15%, or even more. The screen was a bloodbath of red, and nobody was spared. Ethereum, the second largest cryptocurrency, was hit particularly hard. Its momentum reversed immediately as Bitcoin was dragged down. The same fear that gripped Bitcoin holders took hold of Ethereum investors. They saw the market leader collapsing and figured Ethereum would be next, so they rushed to sell to protect their capital. This is a common psychological reaction known as market contagion. Fear is infectious, and people don't stop to ask questions. They sell first and figure out the reasons later, which accelerates the spiral. This only accelerates the downward spiral for everything. A massive wave of liquidations followed. Leveraged traders were wiped out. Each liquidation fed the next. A brutal, vicious cycle. Now, in the middle of all this chaos, smart traders weren't just panicking, they were looking at their charts and identifying key price levels. Let's break this down. In trading, we talk about support and resistance. Think of a price chart as a bouncing ball. Resistance is the ceiling. It's a point the ball has struggled to break through. Lots of sellers sit there ready to take profits. Example, for Bitcoin, $72,000 has acted as that ceiling. The price gets there and is rejected. On the flip side, support is the floor. It's where buyers step in and the price tends to bounce back. Many buyers wait there, thinking it's a good price. Their buy orders create a floor that stops the fall. In the recent crash, Bitcoin fell until it hit support around $66,000. Buyers stepped in, stopped the bleeding, and the price stabilized and bounced a bit. Identifying these floors and ceilings is crucial. These levels come from market psychology and history. Major support, 65,000. Another, 66,000. If Bitcoin breaks below that zone, next major floor could be around 60,000. Upside. First challenge is back above 68, then reclaim 70,000 and finally tackle the sell wall at 72,000. It's easy to look at a 6% drop and see nothing but loss and fear, and for many people that's exactly what it was. But for prepared and strategic traders, volatility is not the enemy, it's the source of opportunity. Extreme price swings create chances for significant profits. When Bitcoin plunged $4,000 in hours, it created a massive discount. For anyone on the sidelines with cash ready to deploy, Traders with buy orders at strong support levels were able to purchase Bitcoin much cheaper than a day before. This is a classic strategy. Buy the dip. It sounds simple, but it requires patience and a strong stomach. Don't panic sell with the crowd. See the panic as a sale, set predetermined price levels, and wait for the market to come to you. Traders who bought the dip at 66,000 saw nice profits as the price recovered. Volatility provides a better entry point. Advanced traders also find opportunity in short selling. Shorting is betting the price will go down. When the whale started the massive sell-off, savvy traders detected huge selling pressure and opened short positions. Some profited on the move down, but it's very risky and not for beginners. Don't use excessive leverage that can get you wiped out in a single flash crash. Volatility separates the prepared from the unprepared. Have a plan, set aside cash, use predetermined orders, act on a plan, not on fear. So let's be perfectly clear about what happened here. This was not a random market event. The whale's actions were almost certainly a calculated move to move the market. They designed the sell to induce panic and trigger liquidations. By selling massive amounts quickly, they made others sell at a loss. This wasn't just profit-taking, it was shaking the tree to see what falls out. So what's the endgame? There are a few possibilities. They may have wanted to exit a big position without tanking the market long-term, or buy back in at lower prices after the panic. They create panic, watch everyone else sell at a loss, and then use their capital to buy up coins at a discount. It's a transfer of wealth from the panicked to the patient. For you, the average investor, the biggest lesson is to pay attention. You cannot afford to trade crypto passively. Track whale movements. When a dormant wallet moves large BTC to exchanges, it's a red flag. Use on-chain analytics, Glassnode-like dashboards, and whale alert tools to get advance notice. These signals give you time to prepare. Set alerts and have a plan. In conclusion, caution, awareness, and adaptation. Don't use excessive leverage. Have answers. Will you sell, hold, or buy more? Set price alerts at key support and resistance levels. You don't have to be their victim. Stay vigilant, learn their games, and use the waves to your advantage.